Let's bring in Stephanie Link, Chief Investment Strategist and Portfolio Manager for Hightower.
Morning.
Also a CNBC contributor. Let's do it for the third time here, Steph, and tell me whether it makes sense. Because what did Forrest Gump say? I'm not a smart man. So 400 on the S&P for earnings in next year, 2027. If you take 20 times earnings, it's a round number. That's 8,000. Is that reasonable after the gains we've already seen in the S&P?
I think so, Joe, and I think it's because the economy is really healthy, led by the consumer, led by the AI revolution, and that's leading to a broadening out in the market into different sectors, because it's not just technology that's going to benefit from AI and the revolution. It's a lot of other sectors are starting to do well. And in fact, last quarter, 7 out of 11 sectors had double-digit earnings growth. But technology took all the credit, right? So I think that we're going to continue to see a widening out of the market. I think you want to own tech, but you also want to own industrials, financials, especially discretionary, with oil prices down 40% from the highs. I think there's a lot to choose from. It
can't be that easy, though, Steph, can it? Just 20 times 400? What is... It's hard to say.
You know what, Joe?
If interest rates go up, you don't get 20 times earnings. So I understand that, but trying to figure out what the multiple should be doesn't seem like that's going to help. But what could go wrong with the 400? And is there downside risk or upside risk? What's more likely on the 400 in earnings?
Well, I think the bond market's telling you that we've already seen peak inflation, which is really very, very positive. And again, that's positive for a lot of sectors, a lot of people, consumers, which is 70% of the economy, but it's also businesses and their input costs. So if inflation has peaked and it's coming down, I know it's not at the 2%, where the Fed wants it to be, but it's coming down. We were running 2.5% in February pre-war. So if we get back down to that, that's really very manageable and, again, very positive. So I think that there's upside to earnings. In fact, I actually thought this year we would see 10 to 12% earnings growth. We just put up 26% last quarter, and we're going to probably do 20% this year. I think we are in the early stages of the AI boom. A lot of sectors are benefiting, and at the same time, the consumer's hanging in there because they have a job and wages are actually still around 4.5%. So a lot is good out there.